All right, everybody, welcome back for another deep dive. You ready to get into it today?
Absolutely. Let's do it.
Okay, so today we're tackling a classic in the world of finance and investing, Benjamin Graham's The Intelligent Investor.
Definitely a must read for anyone serious about building wealth. I mean, it's stood the test of time.
Right, like this book has been around forever.
Hmm.
So we're working from a summary today to really pull out the key takeaways.
Makes sense. It's a dense book, so having a summary can help you cut through to those core principles.
For sure. And we'll be sure to drop a link to the summary in the show notes. But I gotta say, even just skimming the summary, I'm already hooked. There's some seriously intriguing concepts in here.
Yeah, like what caught your eye?
Well, okay, so have you ever heard of Mr. Market before?
Oh, yeah. That's one of Graham's most famous analogies.
So I'm picturing this like Wall Street guy in a pinstripe
Sure.
suit, but in the summary, he's described more like a moody friend.
Haha. Right. It's not about a literal person. It's a way to understand how the market behaves.
Okay, I'm intrigued. So tell me more about this moody friend of ours.
So imagine Mr. Market comes to your door every day, wanting to do business with you. He's always offering to buy or sell stocks.
Okay, sounds kind of pushy.
Yeah, well, that's the market for you. Always trying to get you to react. But here's the thing. Some days Mr. Market is super excited.
Like he's found the next big thing.
Exactly. And he's willing to pay top dollar. Other days he's totally down in the dumps.
Like he thinks the world's ending.
Basically. And he's practically giving his stocks away. But here's the key. Mr. Market is driven entirely by his emotions.
Ah, so he's not always making rational decisions.
Oh, and that's where the intelligent investor comes in. You can't let Mr. Market's mood swings dictate your moves.
So how do we do that? Like, how do we stay level-headed when this guy's acting all crazy?
It's about understanding that his prices don't always reflect the true value of a business.
So it's like he's offering you a candy bar for $10 one day,
Yeah.
and then the next day it's 50 cents.
Exactly. And you wouldn't just blindly accept whatever price he throws at you, right?
Well-
You'd do your research.
You'd figure out what that candy bar is actually worth.
Yeah. And that's where the concept of margin of safety comes in.
Oh yeah, that was another term that jumped out at me from the summary. What's that all about?
It's basically like having a buffer, a
Oh.
safety net.
Okay, that makes sense. Investing can feel risky, so we need a little protection.
Exactly. Let's say you're looking at a company and you think it's worth $100 per share.
Based on its, earnings and assets and all that.
Right. But Mr. Market, in his current mood, is only offering $80 per share.
Score. We're getting a deal.
Well, that $20 difference is your margin of safety. It means even if you're a little off in your valuation, you're still buying at a discount.
Ah, so if the company's actually worth $90 instead of $100, we're still in good shape.
Precisely. That margin of safety helps protect you from those inevitable surprises and market fluctuations.
This is making a lot of sense.
Mhm.
But I gotta say, it takes discipline to not get swept up in the hype, right?
Definitely. The summary uses this great analogy of a roller coaster to describe how investors often feel.
Oh yeah, I remember that part. It's like 1 minute you're on top of the world, and the next you're plummeting towards the ground.
And those emotional swings can lead to bad decisions. You might sell in a panic when the market dips.
Or buy something just because everyone else is.
Exactly. That's why it's so important to detach yourself from those short-term fluctuations.
And focus on the long game.
Exactly. You need to be thinking years ahead, not days or weeks.
So how do we actually find those good long-term investments? Like, where do we even begin?
Well, the summary describes value investing as a treasure hunt, which I think is a pretty accurate description.
Okay, that sounds kind of fun.
It is, in a way. It's about looking for those hidden gems, those
Mhm.
undervalued companies that Mr. Market has overlooked.
So it's like we're going against the grain, not just following the crowd.
Exactly. You're looking for companies with solid fundamentals, strong financials, good management, a competitive edge.
But maybe their stock price doesn't reflect that yet.
Right. And that's where you have the opportunity to buy low and hopefully sell high down the road.
I like it. But finding those diamonds in the rough takes some serious research, right?
It does. You need to be willing to dig into financial statements, read industry reports, really understand a business.
Not just jump on the latest trend.
Exactly. Value investing is all about patience and due diligence.
Speaking of patience, the summary also talks about time being a powerful ally in investing. How so?
Well, it uses the analogy of a long road trip. Think about it. When you set out on a road trip, you're going to encounter bumps along the way.
Traffic jams, detours, maybe even a flat tire.
But those short-term setbacks don't change your ultimate destination.
You still keep your eyes on the prize.
And it's the same with investing. There will be ups and downs in the market.
But if you've chosen your investments wisely and you have a long-term perspective, those short-term blips won't derail you.
Precisely. Time allows your investments to grow and compound.
So even if we hit a rough patch, we don't panic and sell everything.
Exactly. You got to ride out those storms and trust in the process.
But it's not all about picking individual stocks, right?
Mhm.
The summary also talks about diversification.
Oh, absolutely. Diversification is key. It's like building a well-rounded meal.
The investment salad, as the summary puts it.
Uh-huh. Exactly. You wouldn't want a salad with just lettuce, right?
Need some tomatoes, cucumbers, a little cheese maybe.
Exactly. And your investment portfolio shouldn't be all in one type of asset.
So we're talking stocks, bonds,
Hmm.
real estate, maybe even some alternative investments.
Right. You want to spread your risk across different asset classes. So if one sector is performing poorly, others can help balance it out.
That makes sense. But how do we know how much to allocate to each asset class?
That depends on your individual risk tolerance. Some people are comfortable with more volatility in pursuit of higher potential returns.
They're like the thrill seekers of the investing world.
Haha, kinda. While others prefer a smoother ride, even if it means potentially slower growth.
So it's like choosing the right level of spice for your investment dish.
Exactly. You got to find what you're comfortable with.
This is all great stuff. But I gotta say, the world of investing feels like it's constantly changing. New trends, new technologies, new risks.
Absolutely. That's why continuous learning is so important.
You can't just set it and forget it.
Nope. You got to stay up to date on market trends, read books, articles, financial news.
Maybe even listen to some good podcasts.
Hey, there you go. The more you learn, the better equipped you'll be to make informed decisions.
It's like working out your investing muscles. Gotta
Yeah.
stay sharp.
Exactly. You want to be able to adapt your strategies as the market evolves.
So let's take a step back for a second and recap what we've learned from The Intelligent Investor.
Sounds good. Let's solidify those key takeaways.
All right, so we started with this idea of Mr. Market
Mm.
and how he's driven by emotions, not logic.
And how we as intelligent investors can't let his mood swings control our decisions.
Right. We talked about the importance of margin of safety, having that buffer to protect us from unexpected events.
And we dug into the concept of value investing, looking for those undervalued companies that Mr. Market might be ignoring.
We also talked about time being our ally in investing
Yeah.
and how we need to have a long-term perspective.
And the importance of diversification, spreading our risk across different asset classes.
And of course, we can't forget about continuous learning, always driving to improve our knowledge and adapt to new market conditions.
It's like we've built a solid foundation for approaching the market with intelligence and discipline.
I like that. So now that you've had this crash course in intelligent investor wisdom, I'm curious, what's resonating with you most?
Honestly, the biggest takeaway for me is the importance of emotional control. You can have all the knowledge in the world.
But if you let fear or greed take over, you're going to make bad decisions.
Exactly. It's about staying rational and focused on the long game.
I think that's something we could all apply to our lives even beyond investing.
Absolutely. Controlling your emotions is key to success in so many areas.
Couldn't agree more. So for anyone listening, I want to leave you with a question. What kind of investor do you want to be?
Do you want to be reactive and emotional, letting Mr. Market dictate your moves?
Or do you want to be proactive and disciplined, making informed decisions based on logic and research?
It's your choice.
And remember, while this deep dive has given you some great insights, it's always a good idea to talk to a qualified financial advisor.
They can help you create a personalized investment plan that aligns with your specific goals and risk tolerance.
Couldn't have said it better myself. So until next time, happy investing, everyone.
And remember, stay intelligent out there.
See ya.
Bye.